Hello, folks. Happy Sunday. Got the audio. Hope you guys are doing well. Let's get an audio check here on my end. All right, should be good to go. How's everyone doing today on this fine Sunday afternoon? Hope you guys are doing well. Ready to get back to business here. Sure. Should be good to go. Wait for some feedback here on my end. Gary, what's going on, my man? I'm doing fantastic. Hope you're doing great. Eslam, hello, sir. I'm glad to be here. All right, guys, so we are back to business. Happy Sunday to you, sir. Alrighty, guys, so we are on the other side of FOMC. Hasn't been intraday the easiest price action, but at least for my trading, getting things back on track post FOMC with easier price action we've had. So getting things back on track on my trading, a little bit of a speed bump to start September, but as long as you manage it well, again, it's just a little speed bump in the course of your trading career. It's not ending yet or anything like that, but not the easiest intraday price action. Post FOMC, though, we definitely did clean up. All targets were delivered, dollar, euro, indices, obviously business as usual. But now we just need this intraday price action clean up here a bit. So with that, guys, we'll go ahead and get into what we're looking at. We got some interesting things with the US dollar, with bonds, and if I have some time, I might cover some of the COT information that's helping me qualify this reversal in the US dollar that we're looking at. So with that, guys, let's go ahead and get right into it. If you guys have any questions, I don't have as much time here today. I'll take the best 3 questions that I like, and then I'll move forward from there. So if you guys have your questions, get those typed up. As soon as I'm done with my analysis, I will hit those and keep it moving forward, guys. So let's go ahead and get down to the business here. Alrighty, so we're going to take it all the way from the monthly here. Again, to have precision, you need to understand monthly, weekly, daily for a macro perspective. And then that's going to make, obviously, the intraday trading so much easier when you understand where these higher time frames are going. So again, you always need to focus top down because the markets are also being delivered top down. So let's take it from the top here, monthly chart for US dollar. So what we've been watching here, well, actually, before I even zoom into the details here, let's just look at bigger picture. Bigger picture, where are we at with the US dollar as it relates to this monthly range? We're trading within this low to this high here. And we can see here we have our equilibrium price point, right? We are in a discount market. That doesn't mean the market can't go lower. It just means we're below equilibrium. So what I've been watching is how we trade below equilibrium and inside this last down close candle. Why this last down close candle? Because this is the last down close before this impulsive run higher. So that tells me that the deep pockets, the smart money was buying here. So when it comes back down to that level, that's why we had that as a target when we were bearish here, because again, order blocks can be used as targets as well. So we hit that bullish order block. We rallied higher. We hit that inversion fair value gap that we were watching last week. So I'll do a short recap of kind of what we saw last week. And then that'll segue us into what we're looking at here. So again, I always like to look. One second, make sure it's on all time frames. I always like to look back before we look forward, right? Because then where prices come from is going to give us context as to where it's going. So looking at what we saw in the recent price run, we had this fair value gap here, which again was used as support, but then it inverted its role, right? That's why it's called an inversion fair value gap. So we got to traded up into it here. First we got below it, then we traded up into it, respected it, sold off. So it's an easy price run into this swing low here on the monthly chart. More specifically, what I'm watching though, I'm going to take this range off here. But I'm watching this order block here in a discount, because if we're going to be bullish from this discount here, then I would want to see it happen here. And I'll go into the commitment of traders and also show you guys some insights that I'm looking at there. Hey, what's up, Samad? Happy Sunday, brother. So we have this down close candle here. I'm extending that through. And then the black line here is going to be the 50% or the mean threshold, which is, again, 50% of that down close candle. We'll look at that on the lower time frame. So I'm going to take this off here. But again, that's what set the stage for the easy drop that we were looking for into this swing low here. Now that we've hit this bullish order block in a discount, I want to see how we trade from here going forward, because we could be seeing a longer term reversal on the US dollar. And I'll get into those details here in a moment. So looking at the weekly chart here, easy bias last week just to drop down into this low here. We had all the market structure, institutional order flow, everything pointing to dollar rolling over to the downside. So easy money into the equal low here, or sorry, not equal low, into this swing low rather, and then into this black line, which is again 50% of that monthly bullish order block. And again, why that one? Because it's the last one before this explosive run higher. So institutional sponsorship came in there. So now looking at the weekly chart, what did we see after we engaged with that low? So once we had the targets that we were looking for last week, once they delivered, what did we see the market do? Quickly snap higher. If you are bearish, you want to see what? Let's take it from the top here. We have this swing low, displaces down through it. This swing low displaces down through it. This swing low displaces down through it. So when the market is bearish or institutional order flow is bearish, the market will displace and move energetically through old lows. However, one of the indications that we could be petering out or seeing a end of the trend or a reversal, in other words, is when you start seeing the market reject lows. So what do? We drop down below the sell side, quick rejection higher. So what's that telling me? Who's stepping in and buying here? Smart money minded traders. So what I'm looking at here is potentially a long-term reversal in the US dollar. And again, commitment of traders is also further solidifying this because we're seeing commercials increasing their net long position. So not only are we at a deep discount, we've taken out sell side and the commercials are loading up the boat with long positions here in this deep discount. So those are things that are boding well to higher prices for the US dollar. So we dropped down, hit the low that we were looking for last week, quickly snapped higher, and that could be again indicating a reversal. So what I'll be watching here going into the new week is how we trade inside this wick. So now we have a wick below market price. I'd want to see us stay in the upper half of that and then just keep ripping higher. Working down into the daily chart here. Kennedy, Michael would say a doji candlestick on the higher time frame signals a reversal. Absolutely, right? And here's the key with dojis, right? By themselves, they don't mean shit. You have to understand context, right? And all the context that I laid out here is why this doji would be appropriate. But let's go to another example here. Like, for example, if we look at the NASDAQ, and we'll look at like a daily chart, for example, right? Let's say you pattern traded dojis, and you see this doji here, and you think, oh, it's a reversal. We're going lower. That's a pattern trade. Why? Because indices are bullish. So, Kennedy, that is a good point that you bring up. Just don't get caught up pattern trading it, because if you just look for dojis randomly, it's not going to help you. So you have to understand context as to what would constitute a reversal. Then if you get the signatures like ICT taught, which is a doji candle, it could obviously signal a reversal. So I just wanted to touch on that caveat there because I don't want you to think it's easy as low. Look for the doji 1, 2, 3, because if you did that here, you would have got toasted. So you have to understand context above everything else. So let's go back to dollar here. So back to the weekly chart here. Nice rejection higher. I want to see us stay in the upper half of that wick and then start to traverse higher. So now let's look at this on the daily chart here. Look at the details here. So again, that big blue rectangle there, that's a monthly bullish order block. And again, we have the 50% of it. You can see they dropped down. Look at where that low formed there. Perfect. Beautiful. Level we've been watching for months. So we cleared out the sell side here. That's been taken. And then we've seen a strong rejection higher. This gap has been closed above, treated as an inversion fair value gap, but you can see they dropped down, use it as support, rallied higher. So for my bias this week, these are red. They should be green. Sorry. My buy side liquidity pools are green. Let me change that real quick. Helps me keep everything organized when I'm looking at the numbers here on the right. I know my red is going to be sell side liquidity. Green is going to be buy side. So that's just something I like to keep charts organized. So we got above this gap here after taking out the sell side. So what have we seen in US dollar throughout this year? Just completely rolling over to the downside. We've already dropped into a deep discount, so it would be reasonable for the market to turn from here. And there's a lot of other factors that are behind it as well, and I'll cover that here for you guys. So as long as we stay above this inversion fair value gap here, I am bullish US dollar. Looking for buy side here. First target is going to be 98. We'll just call it 98, big figure number. Above that, we have 98,635, and then above that we have 98,834. And then if we traverse through all these highs here, then my attention is going to go to this imbalance here above market price. Dropping down into the 4-hour chart. I remember we were talking about this fair value gap here, and then the market rolling over from there into these lows. So really nice price action that we saw in the higher time frame as it relates to the US dollar. Then once we reached these targets here to the downside, what did we see from the market? Quick explosiveness higher. So that to me is lending well to a market reversal. And from there, I'm looking for, again, the highs here. These equal highs here, all the liquidity engineered on the run down. And now I'm thinking they're going to want to run up for the buy stops here. The funds want to be short here, right? They're thinking interest rates are going lower, which can be a factor. But I'm looking at it through the market efficiency paradigm, where the smart money is cleaning up the uninformed money. So I'm thinking everybody wants to be bearish dollar now, right? Interest rates are going lower, so dollar has to sell off. And in my mind, the institutions or the commercial traders have been absolutely loading up the boat with long positions. So they're buying this deep discount. Retail, uninformed money wants to be short because they think interest rates are going lower. So in my mind, being a natural contrarian, as we are with ICT traders, it makes perfect sense for them to send this thing higher. the market efficiency paradigm, they're going to fleece the uninformed. And in my mind, the buy stops here are a little too juicy to leave intact. So 4-hour chart, those are the targets here. Zooming out a little bit. Once we get above these equal highs here, again, we have that nice exposed area here, which is this imbalance to trade up into as well. Let me share some other confluences here. I know usually I don't go into euro and pound because obviously it's just the opposite, but there are some indications in the euro and pound that are helping me qualify this market reversal profile. So we're going to look at silver, absolutely ripping. Same thing with dollar, right? Telling you guys, or sorry, same thing with gold. Telling you guys we're raging bulls on the metals market, but that's another conversation. We'll get back to that. All right, so looking at the euro here, what we're going to do is compare the market structure with euro and a closely correlated asset, which is the pound. So before we go into foreign currency, what have we seen in the dollar? We've dropped, we're in a deep discount and potentially looking for a market reversal profile. Now, I want to look for other indications that we're seeing a crack in correlation and that we are going to see a reversal. One of which those tools is a SMT divergence. So now looking at the market structure and the euro here above and the pound below, what are we seeing here with euro? Euro made a higher high here. While at the same time, the pound said, no thanks, I don't want to take out this high. When I'm looking for a reversal in these markets. So now this is just basically like the nail in the coffin. I don't need SMT to trade, but if I have it behind what I'm looking for, it's even stronger. So now what do we have the stage set for? Dollar's in a deep discount. Everybody wants to be short dollar. Commercials are absolutely loading up the boat with long positions. And we've seen an SMT at the highs between these correlated assets. So in my mind, everything is a green light for lower prices in foreign currency and higher prices in the US dollar. Moving right along here, let's go to the bond market, because now I want to confirm what we're looking at in the currency with the bonds. So what are we seeing in bonds here? Bonds are in a consolidation. They have been for a while, and that's why trading hasn't been as easy as well, even the last couple of years, simply because the bond market's been in consolidation. When bonds are trending, market conditions are so much easier to trade and work with, because now when there's sponsorship in the bond market, it's going to allow everything else to move more freely. So bonds have been in a consolidation on the monthly chart, but we can still drop down to the weekly, daily, and sort out some information there. So just keep in mind, we're still in a higher time frame consolidation as it relates to the bond market. And now dropping down into the weekly chart here, we saw the market create a swing high now. So we have a high in the bond market. We drop down into that weekly fair value gap. And what I want to see is this fair value gap fail. Because if we break down through that imbalance, that would be bearish for bonds, which would further support higher prices in the US dollar. Dropping down to the daily chart here. Paul, this answers your question in terms of how we use SMT with the bond market. If you hang around me long enough, eventually you'll get through all these points. So just to touch on your point with regard to how we use SMT as it relates to the bond market, here's a perfect real-time example that I'm using to frame a reversal in the US dollar. So when we're comparing the highs, like we talked about when I was answering your question in the forum, I'm not as concerned with the yields, right? Because the treasuries, the bond treasuries are going to tell you more than enough. So you don't need to compare the highs and lows with the yields and the treasuries. The treasuries are more than enough, as you can see here. So what do we see here with the 30-year? It posted a higher high here on the 17th of September. What we see on the 10-year is it failed to make a higher high here, and then we see it failed to make a higher high here. When I'm looking for a reversal, right? So it's not a matter of just randomly looking for SMT. It's not going to help you because there's SMT all over the place. And if you don't know what you're doing, it's not really that effective alone. But if you understand context that we're already looking to frame a market reversal and you see that SMT, in my mind, it's an additional confluence signaling we're going to see a reversal in bonds. Now, why is that helpful? Well, if I'm looking for bullishness in the dollar, I want to see weakness in the bond market, right? Very similar to how these past few months we've been calling dollar what? We've been calling dollar lower. What supported lower dollar? The bonds rallying here. So you see how there's a interconnectedness between these markets that you want to identify for precision-based trading. So now dropping down to our 4-hour chart here, we can see it's a bit easier now. We can look at the highs comparatively. And we can see here that as the 30-year punched higher, made a higher high, we did not see that same higher high in the other treasuries. So this could be signaling a longer-term reversal. And again, this would bode well for higher prices in the US dollar. So that's what I'm looking at in the bond market. In terms of downside targets here, initially I just look for a discount of the range. So we have this range low, this range high here. So I'd like to see them at least drop it down into a discount, and then how we trade from there will be indicative as to what we'll do longer term going forward. So all the factors and confluences that are supporting this reversal here in dollar that I'm looking for. So lots of factors behind this here. And then if I'm wrong, we'll get below this inversion fair value gap, break down, and then I'll have to concede and then get in line with what the market's giving me. As of right now, though, we're bullish dollar. I'm bullish dollar, rather. All right, moving right along to NASDAQ. Really nice delivery last week, if you guys remember. We looked at this low to this high here, ran fib projections, and then I gave you that -2 level specifically. And then you see really nice high of the week there, really nice delivery. And why is that? Because again, the monthly candle opened here, so they dropped it, expansion. So we'll cover that in a moment here. Let's look at the monthly chart. So for currency traders, I know a lot of you guys are here for index futures, of course, but for currency traders, a lot of things you want to mention. So a lot of things I mentioned here that you want to take note of going forward. So how the market is reversing, commitment of traders, SMT between euro pound, and then even further precision ringing in the bond market. So keep in mind for currency traders, you need to be looking at all those asset classes for precision. With indices, of course, it's still helpful to have those intermarket confluences, but it's not as imperative as for Forex traders. So looking at the NASDAQ here monthly chart, so we called the low of the month here inside this wick, right? We dropped down, we hit the 50% of this wick. We called the low of the month here before we even took out this high. And from there, we've been seeing a bullish monthly expansion. Again, Dylan, you're a day trader. Why do we even look at the monthly chart? Well, if I understand the monthly chart is bullish, what does that mean for the weekly chart? What does that mean for the daily chart? What does that mean for the 15, right? The 5, the 1 minute, right? So it's all top down, it's fractal. So looking at the monthly chart here, why were we so bullish on this monthly candle? Well, two factors. Look at these breakaway gaps here. The imbalance is not willing to get filled. And what did we have in August? We had a small range month. So large ranges precede small ranges. So we had a small range here. After a small range, we get a large range. So that's why you don't want to blow all your powder in August. You want to take it easy. Look, it wasn't doing a whole lot. And now the next subsequent month, expansion, easier price action to work with. And not that it's really been that easy this September, but easier in terms of at least it's not consolidating here. So low of the month, easy to see 3 to 4 weeks, about 2-3 weeks ago when we made that low. Previous month's high attacked, and then now we're trading to it and through it. So I'm still looking for higher prices on the monthly chart. Nothing has changed. Now zooming into the weekly here, we see this down close candle, which was the bullish order block in our analysis when we were trading here. And that's what gave us the confidence to look for a bullish weekly candle here and then a bullish weekly candle here. The next weekly candle, I'm still anticipating it to be bullish. There's nothing that's telling me to go short. And again, you do not want to be the person trying to call a top in this market. It's just a loser's game. There's a lot better games worth playing, and trying to call a top in index futures is definitely not it. When the top is in, it's in, and we'll be able to see that when it happens. But as of right now, again, we keep trusting bond models, looking for higher prices. Alrighty, looking at the daily chart here. And then again, just on the weekly, I just want to touch on institutional order flow because I just want to keep it basic. I know there's a lot of components, a lot of different things to what we do, but at the end of the day, it can be really simple. What are we seeing? Down close candles and gap supporting price. So what does that mean? Institutional order flow is bullish. Keep looking for higher prices. Don't overcomplicate it. All right, so now dropping down into the daily chart now with the refinement of knowing the monthly is bullish, the weekly is bullish. Now, how easy does that make the daily chart analysis? Much easier, right? Again, that's why you have to understand price is fractal, look at it top down. So looking at the daily chart here, we had this sell side liquidity run here that we saw here. This high taken out, traded to it and through it. This week here, this is Monday's open. So we had Monday, Tuesday, Wednesday made the low of the week. Why is that? I get asked all the time about weekly profiles. Dylan, is that something you look for? Absolutely. Why would we look for a Wednesday low of the week? Because what was the hardest hitting news driver we had this week? FOMC on Wednesday. So that is that component of time and price, right? Prices, we're bullish, we're looking for higher prices. Time is when are they going to make the low of the week? The economic calendar is very instrumental in predicting that. So we saw Monday, Tuesday rally, Wednesday drop down below Monday, making the low of the week. And then we saw a subsequent expansion Thursday into Friday after that Wednesday low of the week was priced in. So weekly profiles are always a consideration, but you have to understand where's the market going, number one. Then from there, the economic calendar is very instrumental in predicting these highs and lows of the week. And these are things you want to start studying, right? When is the low of the week getting made? Is it on Tuesday? It is on Wednesday. What was the economic calendar that supported the higher low of the week being made? And over time, you're going to start to see repeating characteristics that you can then trade with as well. So on this drop on FOMC, we saw this drop here into this down close candle or bullish order block here. Nice reversal here. So like we were just talking about, right? Dojis being a reversal in the proper context. So the market dropped, Doji, market's continuing higher. So if you're just pattern trading dojis, you see there's a doji here and a doji here. So it's not really that helpful. But if you understand that the market's primarily bullish, well, we're not going to look at this doji here as a reversal. That doesn't make any sense, right? But this one here was just dropping down into order block, quickly snapping higher. Thursday, Friday, bullish. So my upside targets on the daily chart here, I'm looking for that 2,500 big figure number. And then through that, I like 121. But Dylan, the dollar is bullish. How are you calling NASDAQ higher? I am not calling the top in this market. If the dollar is going to rally and just have an insane move to the upside, then that'll probably put pressure on indices. When that's the case, though, the market structure and order flow will reflect that. As of right now, again, I'm not looking to call a top in this market, even with bullish US dollar. So if the market does reverse with strength in the dollar, then that's something we'll have to see. But as of right now, again, you don't want to call a top in this market because they'll keep sending it higher, and it can be very frustrating if you're trying to go short every retracement. Short, stopped out, try to go short, stopped out. It's just better to stay in line with the higher time frame order flow. Alrighty, so these targets here, you're probably wondering how I got them, so let me share that here. So we have this breaker here. See how that's converging at the 25-120 level. And then we drop down into the 4-hour chart. You can see two levels converging at that 25-120, right? That was the same thing that allowed me to give you guys this target this week, because we have the convergence of those key levels with key market structure, right? The reason these fib projections are so accurate is because I know what market structure to anchor the Fibonacci to, right? So it's not just randomly doing highs and lows. You have to understand market structure, and then within that market structure, certain price legs are going to give you the targets that you're looking for. So I like breakers for predicting highs, and I also like manipulations, runs against the higher time frame direction to frame fib projections. So going up to the daily chart, institutional order flow is bullish. Nothing in my mind is saying this market's bearish. We're still seeing what? Down close candle here, supporting price. Down close candle, trades down into it, supporting price. Imbalance here, support. Market drops, rallying. So everything is still bullish. Institutional order flow is bullish, so I'm not looking to go short this market at all, unless you're doing intraday scalp. So I did take a short and made money this week going short manipulation at 9:30. So shorts can still be taken. We just have to manage them appropriately, which means know what you're looking for if you're going short. Get in, get paid. Don't overstay your welcome, because like you see this previous week, drops are very short-lived, right? So it can still drop, but it'll more than likely be a short-lived drop that you don't want to marry the vein, hold it, and then it's going to reverse on you rather quickly. Alrighty, so 4-hour chart here. So this is the FOMC drop we saw on Wednesday. What these major news drivers are generally designed to do is be disruptors. ICT did a really good job of explaining this in one of his lectures. I don't remember. His guy has so many lectures. And actually, most of the sauce is in the Twitter spaces that are 4 hours long, but that's a whole nother conversation. Good dude, though. All right, so one of the things, what do I mean by disruptors? The major three events, CPI, NFP, and FOMC, generally I look for those to be disruptors. What does that mean? Well, what's the underlying order flow been recently? Who's been making money? Obviously, people on the long end, people that have been in long buy positions. Well, during these disruptor events, many times they'll upset the current order flow. So the order flow has been bullish. So what they do on FOMC, they sink it into sell side here and then into these bodies here. That does what? Anyone that's long and has their stop trailed too tight, they get stopped out. Or anyone that's holding longs but doesn't have a lot of conviction, they get squeezed out here on that drop. And generally, it's going to happen around those specific calendar events. So we saw the markets what? Bullish, 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 bullish. It pauses when? During FOMC, and then continues bullish, 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 bullish higher. So economic calendar, you have to understand how to use it. And that's one of the components that helps me understand kind of what the market's doing. Because I'm not looking at this here freaking out thinking, oh, the market's bearish now. I'm looking at this as, okay, we're dropping, we're taking out the low. How do we trade there? And then it quickly snaps higher and then gave us a bullish bias Thursday into Friday. Alrighty, so dropping down into the hourly chart here. We're so close to that 2,500 level, so they may just keep reaching it higher. At the same time, that's what makes all-time highs slightly more difficult. It's easy in the sense that you just keep looking for higher prices, but it's more difficult in the sense that these retracements are a little harder to map out. So as of right now, we have pumped a lot, so it would be reasonable for a retracement. But at the end of the day, because of how bullish this market is, I'm not really going to put a lot of stock behind seeing the market want to drop and clear out sell side, because at the end of the day, order flow is bullish. The market's reaching higher. And again, I just don't want to stand in front of this freight train here. So Next draw is 2,500, and then above that we have 25, 121. All right, so I covered euro, covered pound, the usual suspects. What am I missing? Gold ripping 3,700. And then silver absolutely ripping $43 an ounce. Amazing. So metals doing their thing. And man, wait till gold reaches its actual valuation. And the way they're determining that valuation, it's way artificially suppressed. Because if you look at like the debt to gold ratio, gold is still so undervalued. And I know you're looking at it like, man, 3,700, that's expensive. Gold still has so much room to run. So much room to run. But that's enough of that there. Keep trusting, looking for higher prices on gold. I know a lot of you guys like to trade it. I'm personally not a big fan of trading gold, but just keep trusting your buy models, looking for higher prices in this asset class as well. Again, same thing like we've been hammering with indices the past three to 4 months when markets are bullish and at all-time highs. Keep looking to go long. Same thing in gold. You don't want to be the guy trying to short gold. All right, so let me take a few questions, guys, and we'll get out of here. Stephen, thanks, Dylan. Great insights. Appreciate you, Stephen. Thank you, sir. Amy, hello. Strat King, hey Dylan, why on the dollar daily is that an inversion fair value gap versus balanced price range? Amazing question. Let's go to that. So it can be both. It can be a balanced price range and an inversion fair value gap. So let me go to dollar over here. So technically it is a balanced price range. Yes, that is correct. So the balanced price range is referring to this fair value gap here, which is one pass, and then this fair value gap here, which is one pass. So what that does is it isolates this price action to where the algorithm will not need to come back down into that. So as you mentioned, it is a balanced price range, which is why this is my invalidation level, right? So I was saying, as long as dollar remains bullish, we need to stay above this. If we lose that inversion fair value gap or balanced price range, that would not be bullish. So absolutely, this is a balanced price range. More specifically though, I'm using the inversion fair value gap here, this one, because now on the lower time frames when I'm reading price action, I'm looking at these key levels and I'm seeing how the market trades there, right? So look at how we get above that inversion gap and look at the bodies there. Beautiful. And then it drops down into the inversion fair value gap, but then it does what? It stays in the upper half. That's telling smart money, it's a party, we're going long. So the reason I like this inversion fair value gap is because it gives me these very specific algorithmic reference points that smart money can use, I can use to key off of for just insane precision. So that's why I'm specifically using this inversion fair value gap, but it absolutely is a balanced price range. Yeah. Alrighty. Paul, what's going on, man? How influential is it when indices typically rally during October, November, December, while the DXY is also moving higher? Specifically, how does this dynamic play out on the intraday time frames? Yeah, I got you, Paul. That's a good question. Let me see. In the 15-minute between dollar and indices, yeah. So looking at the dollar, this is how I look at it, right? The indices are going to do whatever they're going to do. Dollar's going to support that, right? So while the dollar's been dropping, it's been very easy for indices to find their legs and reach higher. If the dollar starts to rally, and we do see this as a long-term reversal, and we see dollar really start to pick up steam to the upside, that will eventually cause indices to bend a knee and trade lower. So I'm potentially scouting for the idea of a reversal in indices, but as of right now, the market's bullish. I'm trusting that, and I don't want to give any other ideas like we're looking for a reversal, I'm trying to go short, because I want to keep it consistent, which is we're looking for higher prices. However, if we do start to see a strong rally in dollar, that's going to put pressure on all risk assets, foreign currency, commodities, and indices. So indices can rally in the short term with the dollar. However, if we see an extrapolated move to the upside in the US dollar, that will eventually put pressure on indices and cause them to bend the knee to the downside, because it's all about capital inflows and capital seeking yield. So if the dollar is rallying, what does that mean? That means buyers are, like, capital inflows are coming into the US dollar, which means it's a safe haven investment. Well, if capital's coming into the US dollar, it has to be leaving other assets. So it's going to leave what? Foreign currency. That's why we're going to see sell models in foreign currency. That's why we're more likely to see sell models in indices, because again, that money is going to leave risk assets and flow right into the US dollar. So that's understanding the macro perspective, the fundamentals, if you might, of how the capital is actually moving through the economy, which you have to understand. So all that to say, indices are bullish in the short term, but eventually that will weigh on indices if we start to see a run higher on the US dollar. So that's something I will be looking for, a potential reversal in indices, but it has to show me the market structure and the order flow to constitute that. And as of right now, it's just looking for higher prices until we get to that point. Yeah, so for your next question, how useful is intermarket analysis in terms of high resistance liquidity run and low resistance liquidity run, as in general market structure and anticipations? Yeah, so ideally, for easy trading, low resistance liquidity runs, you're going to have intermarket analysis present, meaning bullish dollar, bearish indices. Like for example, we've been seeing in indices, they've been absolutely ripping. That's been on the back of a weaker dollar. So the best trading conditions, the highest probability trading conditions that are more likely to give easy low resistance liquidity runs, sorry, it's a mouthful, are going to be when you have symmetry in the markets. Symmetry meaning dollar higher, euro, pound lower, indices lower. And when you have that market symmetry, the market's more predisposed to give you low resistance liquidity runs. So we like to see intermarket analysis, but it's not completely required. Because again, in the short term, we can see indices rally with dollar, and we don't just want to randomly short indices because the dollar is rallying. So that's why I look at it. I like to see intermarket analysis for easier trading conditions, but if it's not there, it's not a deal breaker. Awesome. Yes, sir. Thank you very much. Great question as per usual, Paul. All right, Amy, I'm looking to scout and trade NQ with the accumulation, manipulation, distribution during London and the New York session. Okay. So quick question, what are the telltale signs that price is moving in the right AMD direction after hitting the London low, assuming there's a bullish bias? Try to look at the trading. Yeah, so the AMD concept is fractal, right? So that's a great question. So let's drop down to a 15-minute chart. Whenever you're dealing with the daily range, you always want to look at the 15-minute chart. So accumulation, manipulation, distribution. Let's look at it. All right, so we have midnight opening price here. So what do we have here? We're bullish. We've been calling this market higher, right? So what do we have here? Accumulation. We look for low of the data form when during London. Manipulation, distribution. You go in there on your 1-minute chart and you find your model. AMD is fractal though. So this is the AMD of the daily range. Accumulation, manipulation, distribution. Now, what you have to understand is, again, AMD is fractal. So there can be several cycles of AMD happening at the same time. This is where it can get a little more tricky. So if you want to trade the AMD in London, boom, there you go. Now, if you want to trade the AMD in New York, let me take that off here. If you want to see the AMD during New York, what do we have here? This is the 8:30 news embargo, right? So this is when the algorithm will start running to liquidity. And what do we have here? This is another cycle of AMD happening within the greater cycle of AMD that is the daily range. So the daily range cycle AMD is here. Accumulation, manipulation, distribution. Now within that AMD, accumulation, manipulation, distribution on the daily range, well, we can also see it for the AM session. Accumulation, oops, wrong button there. Okay, accumulation, right? Manipulation, and then we see distribution. So AMD is happening on all time frames all day long, but you have to understand the bias. And then like we talked about last week, why would this London low stay intact? Because it already dropped below the opening price. Institutional sponsorship stepped in here. You ideally don't want to see those lows taken out. So it's just an easy London low of the day, New York continuation, and this is just such an easy run to the upside. So AMD's fractal, it's happening on all time frames, but you have to understand again where the market's drawing to, and that's a perfect example of what that looks like. And let's see if we got an example on Friday. I wasn't too dialed into Friday's price action. All right, there you go. Same thing. Same thing the next day. Asia does what it's supposed to do, accumulates. London does what it's supposed to do, manipulates, and then distributes. So all day, every day, like clockwork. You have to understand the bias. And again, we're giving that free 99 here on Sunday. We are bullish, baby. And you can see the same thing here. Accumulation drops down and rallies. So AMD's a beautiful concept. Great to use. Again, it comes down to understanding where the market's drawing to. And then when you understand specific timing components, it becomes very easy to know what you should be looking for and anticipating. Great question, Amy. Hope that was helpful. Yeah, that's what I look for, Eslam. So yeah, we did not get TGIF on Friday, and TGIF is just a simple 20 to 30% up to 40% retracement of the weekly range. We did not see that last week, so we could definitely see that on Monday. Yeah, that's usually my expectation, is look for an early drop on Monday, rally off that. So that's what I'd be looking for sure. Craig, top stuff per usual. Thank you, sir. Good question. Thank you very much. I meant awesome answer. Yeah, no, I got you. I know what you mean, brother. Julian, long time we have not seen the small assistant. Yeah, usually keep the cats out of the office now. They're more of a distraction than a help. they're good assistants when I'm doing like focused work or things that don't require my like trading, things like that. If I'm just chilling, then the assistants come in, but usually gotta keep the cats out of the office. Cats running around the keyboard's no good for business. Alrighty, last question here. Amy, for scalping, what's the best way to determine prices reverse from bullish to bearish, vice versa? After it hits liquidity or after it has hit the discount? Yeah, so the key is going to be understanding institutional order flow, right? So if you suspected, right, like in these examples we just looked at here, right? Let's look at this example we just looked at here, right? So we're going to look at this London drop here. So let's get the midnight open here. So London drop makes the low of the day, right? So let's look at this on a 1 minute chart. What would tell me the low of the day's price in here? Institutional order flow, right? So we're dropping. So you have to have anticipation, right? Anticipation meaning we're already looking at this as a suspect drop because we're bullish. So you have to already have an anticipation that, okay, I'm going to anticipate this drop because smart money predicts, we don't react. So we're going to predict this drop. Then once we see the drop into a key level, sell side taken, we then want to look for indications in the institutional order flow that we're seeing a reversal. How's that seem? Well, we see it trade below the low here. So the market traded below sell stops. Smart money can buy that. And then what proof, what indications do we have that deep pockets are stepping in and buying here? We get a displacement. Fair value gap. Boom. Easy. So all you have to know is how to read order flow, right? And when we're bearish, look at what the market's doing. Up close candle, hits it, sells off. Up close candle, fair value gap, hits it, sells off. Up close candle, hits it, sells off. But then we see a change here. Up close candles, traded to and through. Ooh, that's your click. That's the initial indication that the market is now in a buy model because up close candles are not being respected. So you just have to understand basic institutional order flow. And then when you know what you're looking for, low of the day, order flow is bullish, easy money to the upside. So you just got to know what you're doing. As it relates to institutional order flow, that's the key, right? Because if order flow is not going to confirm we're bullish, then we could just keep dropping. And if you're really aggressive, you can buy here, like buy the turtle soup. But personally, my style is preferring to wait for it to take out the low, then get the change in order flow, because then it's really easy to see it here. But you have to understand, again, your institutional order flow. Thank you for your answer. Yeah, great question. TGF can form in any session, New York, or any session intraday. Yeah, it can happen at any time. Alrighty, guys. Appreciate you joining us. If this one was helpful, do hit the like button on your way out. Great questions, per usual, everybody. Appreciate you guys joining us. Have an amazing rest of your Sunday, and I will see you guys on the next one. Take care, everyone. Have a great weekend.